Started. Hi everyone, welcome. Thank you so much for being here on this Wednesday. My name is Rachel Lieblein-Jabala and I'm the Programs Manager at the Spencer Educational Foundation. And I want to first off just start by saying thank you for joining us. I know the majority of folks on here may be current students who are in the throes of the beginning of their busy roller coaster of this semester. So really appreciate you taking the time to join us today. Secondly, I just wanted to provide some context for today's webinar, especially for those of you who may not know what the Spencer Educational Foundation is, who we are. So Spencer is dedicated to funding and supporting the education of tomorrow's risk management and insurance leaders. And we kicked off this inaugural webinar series in an effort to provide up-and-coming industry leaders like yourself the opportunity to connect with and learn from a myriad of risk and insurance professionals who are eager and willing to share their expertise with you. And I'm so excited to welcome today Ron Davis, Jessica Aguilar, and Guy Miller from Zurich for their presentation, The Global and U.S. Economic Outlook and What It Means for My Career, which I know is super relevant to all of us today, right? I have a couple of housekeeping notes before we kick it off. First things first, this is a Zoom webinar as opposed to a Zoom meeting, which means that you can see and hear us, but we cannot see or hear you. That being said, we want this to be as interactive and beneficial for you as possible. So we're going to have a couple polling questions going throughout, and we encourage you to send in any and all questions that you have. You should see at the bottom of your screen a Q&A box in addition to your chat box. So I encourage you to please put those questions into the Q&A box. That way we'll be able to really go through and make sure we're answering everyone's questions thoroughly. So please send those in. We're going to have a very robust question and answer session at the end of the presentation. So really looking forward to that. Last item of housekeeping is that this is being recorded. So if you know anyone who wasn't able to attend the session today but would like to see, we will be posting this webinar on our website after the fact. So I welcome you to go check that out once it's over. And now we can kick it off. I have the privilege of welcoming Ron Davis, who is the Executive Vice President and Global Head of Customer Management at Zurich North America. Ron is also a board member and former chairperson of Spencer's Board of Directors. Ron, I'm passing you the floor. Welcome and thank you so much.
Very good. I'm delighted to be here, and thank you so much, Rachel, and thanks to the Spencer team for putting together this webinar series. It's really great to see this way of connecting with so many people from across the US, Canada, and possibly even other countries. So as Rachel said, my name is Ron Davis. I'm the Global Head of Customer Management with Zurich Insurance Company. I've been with Zurich for, I'm in my 21st year, and I just love being in the insurance industry and part of such an exciting opportunity to work with customers and with our brokers and with so many professionals across so many aspects and functions of our business. So, as Rachel said, when you think about the context, I mean, Zurich is one of the larger insurance companies in the world, and we deal with all aspects of all segments of the business, in the property casualty business and in the life and benefits business. And we're committed to obviously developing people, retaining people, providing career opportunities to our people, because like in all businesses, the key to engaging and being successful in business is having people that can well represent your company, have the right talent, and to be able to bring the right ideas and the right connections with others and work effectively with other people to create value. We're very well aligned with Spencer's mission, and we've been a supporter of Spencer for many years. We even 10 years ago created a scholarship through Spencer, which is administered by Spencer, but is the Zurich Scholarship. And the reason we do that is that's how much we believe in talent and in the kind of mission that Spencer has. So we're very well aligned. And the reason we created today's webinar together with Rachel and the Spencer team is because we realized that for a lot of young people, the people that either in school thinking about their careers, or people who are just finishing school, starting their careers, or looking for a job, or people in the early phase of their career thinking about, am I in the right spot? What should I be doing? There's a lot of economic uncertainty. So we're going to be able to address some of the challenges that are out there and give you a point of view. And that's where my colleague Guy Miller, who I'll introduce in a moment, is perfectly well equipped to make some sense of all of it and also show that there is some hope. There is some positive elements happening. It's not all bad news. And so we want to make sure that you see How do you make sense of it all, and where can you position yourself in this kind of an economy? And then, speaking about your careers and how do you position yourself, I'm happy that my colleague Jess Aguilar, who's the head of talent acquisition for Zurich North America, will be talking about what are the kinds of experiences that people have looking for a job, what are some of our experiences, and what do our recruiters look for, what kind of advice does she have for people who are trying to position themselves in the best way possible. So that's the idea. And when you think about the insurance industry and innovation and climate change and the use of technology, the range of job opportunities is much broader than most people think. And most people don't fully appreciate how exciting it can be to work in this industry. And it's underappreciated because it sounds boring to people. But for those of us that have been in the business for many years, it's nothing like that. And when you look at this kind of economic upheaval and you see the stability of the insurance industry and how important it is to this kind of recovery that is going on, it just gives reassurance to people that they can have job stability, they can have challenges, they can be well remunerated, they can have international experiences. All of these things are possible. Right now, everybody's staying at home, but in general, that's the way it works. So as Rachel said, we're going to go through, I'll introduce Guy and Jess. Guy will take us through. He'll transition over to Jess, and then we're going to have Q&A. So don't wait till the very end. If you have questions, put them in the chat box, in the Q&A box. So when we're ready to get to the Q&A, we can dive right in. So let me start by introducing Guy Miller. So Guy is Zurich's chief market strategist and head of macroeconomics, and he's part of Zurich's leadership team based out of Zurich, Switzerland. And as in his role as chief market strategist, he's responsible for defining the merits of equities, sovereign debt, and corporate credit across the globe. Guy is also responsible for providing the global economic backdrop that lays the foundation for planning and business decisions. And economic forecasts are made both on short and medium-term basis, capturing the major themes that are likely to shape the global economy. Before joining Zurich, Guy had a number of leadership roles in other organizations, and he has a BA in Honors in Commerce from Napier University and is an associate of the Institute of Investment Management and Research. And I would also mention that last year and again this year, Guy is on the World Economic Forum Financial Futures Council, which explores monetary and fiscal policy and proposes ways of conducting it. So that is exciting stuff. Thank you, Guy, for being with us. And Jessica Aguilar, is Vice President and Head of Talent Acquisition for Zurich North America. She has the overall responsibility for the company's end-to-end recruitment processes, policies, and procedures. And this includes recruitment strategy, university relations, early career recruitment, among many other things. She serves as a member of Zurich North America's HR leadership team, leadership forum, and Zurich's talent acquisition global community of practice. Prior to joining Zurich, she held similar roles in talent acquisition with other major Fortune 100 firms and has worked with a lot of those companies. And she serves as a founding board member of the Flenier Family Foundation in Fort Worth, Texas, a public charity dedicated to the health and well-being of women and children with a focus on health initiatives. And she holds a bachelor's degree in journalism with concentrations in computer science and fine arts from Indiana University. There you go. And now I'm pleased to pass it over to Guy and look forward to hearing your comments, Guy.
Thank you very much, Ron. I'm delighted to be here. The presentation that you see before you, we've titled Phoenix from the Flames. And I think that when we look back to the last 6 months or so, it's really been a dire position. The world has been a global pandemic. We had a recession that we've really not seen for 100 years since the Great Depression of the 1920s and 1930s. But a bit like that Phoenix, there is a bit of hope, as Ron said. At least we're certainly hoping that, and we're seeing signs of that come through. And I'll take you through the presentation that might touch on some of these more optimistic elements that we think lie ahead of us in the next year or two. But maybe before we do that, it's just worth pointing out the slides are quite technical, so please do ask questions at the end, and I'm very happy after this call to take up bilaterally any thoughts or questions or views that you might want to exchange. Very happy indeed to do that. Now, the old saying, there's no such thing as a free lunch, applies once again here. In the modern age of audience participation, we can't throw soft drinks or chocolate bars to the crowd, but we can ask you some polling questions. So maybe if you wouldn't mind participating, it'd be really good to get your thoughts on two key subjects that are close to my heart. And Rachel, maybe you can show them now, I think. So the first question really is, looking over the next 5 years, what are the big issues that you individually are most concerned about? What are the things that really maybe get you thinking during the day? That technology revolution, climate change, income inequality, the lasting effects of COVID-19, the US-China relationships? Maybe if you could vote now, pick the thing that you think over the next 5 years is most critical to you. Maybe we've got about 10 or 15 seconds to run through that, I guess, Rachel. So if you can, please vote now.
We have half of folks voted. Give you 5 more seconds.
Come on, go for it, quick. Very good. Wow, we've even got the results in, excellent. So climate change, I see, has taken takes top spot. It's a close run though between that and the lasting effects of COVID, income inequality, technology revolution less so, and again, Chinese-US relationships falling into last place there. So great, we'll touch on some of that. Now, maybe if I can ask one more question of you, apologies for this, but I think this is important. So we spoke there about the big issues. Maybe Rachel, if you can put the next question up, which looks at the more micro issues about you individually. What are the things that you're really concerned about, you and your friends when you're chatting? What are the things that keep you awake at night? Is it the level of debt that you have? Is it the challenges of finding a job? Is it the affordability of housing? I mean, prices keeping up, is that a major issue for you? Or is it indeed related to COVID, the freedom of movement? We've certainly seen for the first time in most of our lives, these restrictions being placed on them. So for you personally, what are the things that is most concerning? Maybe you could vote now. Again, another 10, 15 seconds on this one, Rachel, please.
Five more seconds. All right, here we go.
Not surprisingly, I'm giving the audience, I'd be surprised if it was anything other than finding a job. So again, that's a good result there and understandable. So we'll come on to that and tie it in with the economics here. Affordability of housing, I think that affects not just students, but it's affecting us all, given the house prices that we're seeing globally. Then freedom of movement. Level of debt, I'm glad to hear, for this audience at least, that level of debt is not keeping you awake too much at night. That's a good thing. But again, for many of your colleagues and our colleagues, it is an issue. So thank you for that. Much appreciated your input in that. Now, maybe if I give you our views. So what I want to do is really take you through some 3 key themes, maybe starting on this page here, and then we'll go through the detail of this. So look, as I said, the good news is that the global economy is in a recovery mode. We're seeing this in the data coming out in most parts of the world. But the important thing to note is that we will still have scar tissue, the lasting effects of that COVID-19 that many of you also saw as a concern in the poll questions that we've got. We're also going to be very much dependent on further and continued policy support in order to keep the economy ticking over, in order to keep job opportunities open. But the good news is, over the next 2 or 3 years, we do think we're in the right trajectory for recovery. We do think that the unemployment levels that have spiked up higher over the last 6 months will continue to gradually come down. But it's not going to be easy, and of course it will be dependent on this pesky virus that we face. Global pandemics, very hard to understand where they're going. But there's some encouraging signs here. Certainly compared to the spring months, we're seeing, although there's signs of a second wave, we are seeing the hospitalization, we see death rates looking a lot lower than they were back then. And of course, importantly, we've got a number of virus vaccinations that are now in clinical trials, and we're again hopeful that something encouraging will come of that. But a key message around this is that we're not expecting the kind of national lockdowns that we saw back in the late springtime. Now, a lot of this economic growth that we're seeing, of course, translates into a better employment environment. And frankly, the economy is a key thing in terms of job creation and finding new roles. But there are a couple of sub-trends that are also worth noting. One of them is technology. We are, again, in the midst of a technology revolution. We're seeing a dramatic shifting in terms of the way jobs are structured. Digitization is taking over many parts of the world. We're seeing jobs disrupted. So understanding what's going to happen there is going to be critical, because again, we see that as a trend that is likely to continue. You mentioned climate change. Again, this is another theme that we think will be driving the jobs market over the next decade. Whether you're trying to mitigate climate change or try to prevent it, there is no doubt it's a major disruptor. And as a result of that, we shouldn't forget, despite all the negatives that are discussed, there's going to be a lot of opportunities created and job opportunities created as a result of these changes. So one must remember that and be dynamic when you're seeing these changes manifest themselves. Now, I also thought one other important factor to put in here, though you're not concerned in the polls about the US-China relationship, there's no doubt that geopolitics is playing a big factor, not only in terms of the tariffs and trade that you hear about, but we're also seeing in terms of effectively a bipolar world. There's now two technology hubs beginning to evolve and develop. And we have to ask ourselves, how is that going to change? Is it going to be a positive in terms of the competition between these economic superpowers, or is it going to lead to duplication of technology, redundant technology as we go forward? I'm always asked about the US and whether it's in the ascendancy or descendancy versus China. I'm always bullish in the US. It's extremely well positioned for the challenges ahead. But, and it's an important but, it must continue to evolve and capitalize on these advantages in order to stay ahead. Now, maybe if we turn to the next slide, and let's look at some of the details behind our optimistic view of global growth. Now, you'll have read and heard a lot about the V-shaped recovery, this mythical V-shape. What is it? And what I show you here is what we call the rolling V. It looks at the PMI indices, purchasing managers indicators across the world. And these are very good indicators of how business is experiencing the current environment, and also how it's likely to evolve. Anything above that dotted 50 line shows that companies are expecting to be in an expansionary period. Below that 50 line, it's a contractionary period. And you can see really for the last decade that most of the regions in the world have been, ticking nicely above that 50 in expansionary territory. But you can see there's been a marked disruption to that at the right-hand side of this chart. And we start off with China, the dark blue line. And you can see Chinese growth, which had been so stellar for the last 20-odd years, suddenly collapsed in the early part of this year as the implications of COVID really struck. Remember, in order to control this global health pandemic, what governments did was they effectively shut their economies down, trying to contain it. They stopped people from going out, they stopped people mingling. And this had a devastating effect in terms of the economic conditions. And you can see that in terms of the Chinese PMI. Now, when this was happening, of course, we were thinking to ourselves, well, what comes next? So we were using China as a leading indicator. And you can see what happened in the rest of the world. As the virus spread relentlessly from east to west, you can see that Europe was next in line. And boy, did it feel this contraction. That red line in Germany was even worse in France and in Spain. You can see its similar profile. Also, it carried on to the United States, the blue line, not quite as bad, but still devastating for an economy that is as big and globally significant as the US. Australia too has been impacted. Now, the point of this chart is to show that there is a V, there is recovery. And if you look at the latest data points that came out last week, you can see there's a little bit of a moderation there, but that's to be expected after this very sharp recovery that we've seen. And although it's still above that dotted line, that's encouraging for the maintaining of this expansion that we're seeing going forward. Now, of course, Australia appears the odd man out. And indeed, Australia experienced its first recession, believe it or not, in the last 30 years, quite remarkable. But what Australia has been experiencing recently is a further shutdown in parts of the country, in the case of Victoria there. And that's resulted in a slightly different profile, a slight pause in this upward move here. But it's something that we think will continue to improve going forward. Now, Rachel, if you turn to the next slide, despite that V and despite that optimism that I spoke about, I mentioned earlier there's a lot of scar tissue. And what I'm showing you here is simply the red line is where growth, global growth, was expected to be tracking both for 2020 and 21. And you can see it's a nice upward trend. The reality, of course, changed. That dynamic was altered by COVID. And you can see the blue line is what happened into 2020. Growth slowed down quite dramatically. And although you can see that V again, it picking up, the important thing in this slide is to see the gap between the red and the blue line, this tram line that you can see going forward. Because what that represents, it represents the lost output that could have been achieved had COVID not struck. In other words, that red trendish growth line is what was expected, the blue line is what the outcome actually is. And to put some figures around that, that gap there that you can see, that's roughly about $4 trillion. Or to put it in graphical terms or geographical terms, that's about the size of the Indian economy that has been given up to what it could have been without COVID. And that's going to be taken away from that possibility every year going forward as that trend line continues. So let's not underestimate the impact of the virus and what it's done on a global basis. Now, turning to the next slide, Rachel, if you go back, we'll go back to the one line chart actually. One after that, one after that. Let me go forward a little bit. Yeah, so we go to this slide here. The thing to note is I mentioned China as a good leading indicator, and I'm trying to break it down a little bit further to ascertain what comes next for the global economy. And you can see I've shown you the three primary components of Chinese GDP. It's industrial production, it's fixed asset investment, and it's retail sales. And you can see just what a torrid time the Chinese economy experienced at the start of this year. Remember, this is an economy that's been used to growing at 6, 7, 8, 10%, and we saw this dramatic contraction. But the key point here is look what's happened to these bars. You can see certainly in terms of industrial production and fixed asset investment, we moved into positive territory back in April. In other words, even back then, this output was greater than it was a year earlier. In other words, we had bridged the COVID and we were back in that growth trajectory. The point is, look at the red line. This is retail sales because they were, of course, decimated as people were not allowed out, and they've gradually recovered. But you can see that's still slightly in negative territory on a year-on-year basis. And the takeaway that we can learn from here is that if you break that down further, you can see that, shop sales are very strong. We can see that car sales are booming. We know that online shopping is very, very robust. So what's the missing ingredient that's pulling that down? And it's very much the service sector. So if we look at restaurant capacity, if we look at domestic travel, if we look at things like theatre, cinema tickets, they're all really struggling. Maybe not surprising given that people are still trying to social distance. And that's something that, again, I think within Europe and within the North American region, we have to be aware that this is going to take longer to come back than we had perhaps hoped for. But again, look at that trajectory, it's still moving in the right direction. The next slide, Rachel, please. Let's narrow it down a little bit because I know most of you are from North America and the United States. So let's focus the next few slides on the US itself. And what I'm showing you here is what's known as the Citigroup Economic Surprise Indicator. And it's quite useful because it's simple. It basically looks at what economists are expecting, what they're forecasting in terms of individual economic data points, housing, retail, sales, industrial production. And then it looks at the actual outcomes and it compares those two, and you can have a positive surprise or a negative surprise on either side of that line. Now look at the chart, we're seeing huge positive surprises. I mean, we've never seen anything like this. The word unprecedented is continually used right now, but again, unprecedented numbers here. So what's going on? Well, back in the start of this year, economists had been expecting a decent economy. Remember that red line I showed? COVID came, they were surprised, it was horrible. You can see that there was negative surprises. And of course, humans being humans, when you're in the midst of this pandemic, you become very depressed and you start to extrapolate this. And frankly, the economists became too gloomy on the economic outlook. And what they didn't factor in enough of was the profound stimulus, this wave of liquidity that was about to hit not just the US, but the global economy. And that's why now we're seeing almost every data point is surprising positively. Now, the next slide, Rachel, please. What is that stimulus and what do I mean by it? And this chart's a little bit busy, but let's keep it simple. So the bars, if you look at the extreme left-hand bar, that's the United States. And this is showing automatic stabilizers, the red line. That's effectively unemployment benefits. So when people get made redundant, almost automatically they can apply and get unemployment benefit. And usually, European markets are a bit more generous on that front than the United States. And you can see that in terms of the proportion of the bars. But look at these blue bars. The blue bars, this is different. This is effectively a fiscal transfer. This is the government writing paychecks out. This is the government providing financial support to small companies, paycheck protection plans. And the important takeaway of this is why this depressionary element that we saw back in the spring didn't become a global depression. Because when you look at the percentage of spending that governments are making to their GDP, it's enormous. So the United States, for example, that far left-hand bar, 16% of the US economy, if you think about how big that is in monetary terms, about 16% of that is the size of the spending that is now being applied to the US economy. And you can see to a greater or lesser extent how the rest of the world has shaped up. But the point is all governments really have stepped up to try and keep the economic productive capacity in place. And what they're most fearful of is unemployment. Because as companies start to shed labor, it's easy to shed labor. It's much more challenging to bring that back. And you have to have a great degree of confidence to do that. So what they're trying to do is preserve that working capital, the workers' capital. In the case of Europe, they've tried that very successfully in 2008. They're furloughing workers, they're having shorter working hours, but they're keeping them on the payrolls. In the United States, there's more direct transfer payments, and you can see that in the data. But this is critical. They're doing their best to keep the employment market going. The trouble is, it's still very much dependent on this liquidity being provided. But the good news is that it is keeping the labor market reasonably healthy, and I'll come on to that in the coming slides. Rachel, the next one, please. Now here we are with the unemployment rate. So let's go down a little bit more granular. The blue line is the US unemployment rate. The red line is the fiscal deficit in the United States. And you can see there's a fairly tight correlation between these two elements. And it's not surprising as unemployment picks up, as the blue line rises, we have to pay unemployment. These people are not working, they're paying less taxes. It's not surprising the fiscal deficit rises. And you can see for the last 50 years, pretty much, that's been a fairly close relationship. But look what's happened recently. Look what happened really from 2016 onwards. Unemployment continued to plunge. At the start of this year, we were at a 60-year low in the United States of around 3.5%. But look at the deficit. The deficit was rising, not falling. That's unusual. And part of that was, of course, a function of a changed taxation policy that was implemented over the last 3 or 4 years. But look at where we stand today. So the good news is, look at that unemployment rate. It spiked to, again, that word, an unprecedented rate, 15.5%, unheard of. But then look what happened. It's now plunged as of Friday, when the data came out, it was back at 8.5%. We went from the best employment situation in 60 years to the worst in about 2 to 3 months. Again, remarkable. So unemployment is coming back down. That's a good thing. We think that can continue, maybe not at the pace that we've seen. But look at that deficit. That deficit's not coming down. That deficit will continue to rise. And as additional stimulus is applied, which sadly it's required because we're still in a very fragile situation, that deficit will continue to rise and be a challenge for how that's dealt with in the years ahead. So Rachel, let's move to the next slide and think about how that money is being deployed. And again, this is a pretty simple chart here. The blue line is the savings rate. This is a percentage of disposable income. So after you've paid your essentials, what have you got left? The red line simply retail sales on a year-on-year basis. And look at the recent data points. When the US economy was locked down, maybe not as much as we saw in some parts of Europe, but when it was locked down, guess what? Retail sales plunged. People couldn't spend. They couldn't get out and shop. But look what happened to the savings rate. The offset of that is if you can't spend money, then clearly you still got that money. And therefore we saw the savings rate spike. Now, the important thing about that is compared to 2008, you can see it didn't really spike back then. And that's because the stimulus was nothing like as big as what we've seen. Remember I said about these paycheck protection plans? Remember what I said about these furloughed workers? Workers are trying to be protected, and that's led to this jump in the savings rate. Now, not surprisingly, of course, as the economy begins to open up, then people start to spend again. There's almost a pent-up demand to buy that thing that you were really wanting that you didn't buy the last 3 months. And lo and behold, the savings rate has also come down. Now, remember, that chart I showed you about China. Retail sales never really got back up on a year-on-year basis. But, you know, the great thing about US consumers is they like to spend, and they're spending when they can. And guess what? That line is now back up on a year-on-year basis. So again, this might wane a little bit because, of course, that pent-up demand begins to dissipate. But the point is that money that is being spent by the government to support these wages has resulted in the retail sales picking up. Why is that important? Because 70% of the US economy is really based around consumption, and therefore it's critical that consumption continues. Now, speedily, Rachel, sorry, you're getting a sore finger there, moving rapidly through these slides. The housing market, this has kind of surprised me because, of course, for the last 10 years, we've been recovering from the bursting of the housing boom. But whether it's new home sales or existing home sales, you can see that significant track upwards. And even the pandemic couldn't stop this uptrack and the momentum here. Small V, but another V, and we're back up at very strong levels. And why is this important? Because one, it's usually a household's single biggest item, their house. And secondly, it's usually leveraged. They have to borrow money to take it on. So in order to do that, they have to feel quite confident about their job prospects or their current job in order to pay the mortgage. But the reason I'm showing it here is also because when you buy a new home or you buy another home, what do? You renovate it, you paint it, you buy furniture, you buy a new TV. So it's quite a good indicator of what's going to happen in terms of the economy in the months ahead. Clearly not foolproof, but when you get these strong numbers, there is usually a spillover effect to the broader economy. Now, the next slide, Rachel, is trying to narrow this down to particularly this audience, because I mentioned about spending. So governments are spending globally, and of course in the US, their debt level is at record levels and rising. Soon the US debt level will be above the size of the economy, more than 100% of GDP. But you're in good company, it's 250% in Japan, and parts of Europe it's 140%. So debt levels are high, corporate debt levels are high, consumer debt levels in the US have come down a bit. But if you look at student loans, for the last 10 years, they've been a one-way bet. They've been going up, both in terms of the number of loans that are being generated and the size of these loans. So at the end of 2019, the average loan was about $35,000, a significant amount of money, but that's skewed to some very big indebted people there. That's why I'm very glad to see our participants are not worried about debt. So obviously that's a good thing. But if you look at the red line, this is basically delinquencies. And you can see that despite the fact that the amount of debt has been rising, delinquencies actually have been pretty constant over the last 10 years. And of course, that's been a function of interest rates plunging. As interest rates go lower and lower, you can actually afford to service higher levels of debt. Yes, it's a risky strategy because if interest rates ever go up, suddenly that carry cost of debt becomes a real issue. But I've circled the last data point because as part of all of these fiscal initiatives, one of the things that has been applied is holidays in terms of some repayments. There are different tools in different areas, but broadly speaking, that there's been some flexibility given. So you're finding that these delinquencies are not rising, but at some point, of course, they'll still have to be paid back. So it's still important that we realize these debt levels are high and still a risk. Now, Rachel, if we move on again, what I've been speaking about up until now is fiscal policy. So this is the government providing support through the taxes that they've collected. What I'm now showing you in this psychedelic chart here is a monetary element. So this shows you the balance sheets of the world's central banks. And what, of course, is they've been doing over the last number of years, they've been slashing interest rates. They've been cutting rates to what's known as a lower bound. They can't really go any lower. And indeed, in Europe, and certainly here in Switzerland, we've got this bizarre concept where we've got negative interest rates. So you actually get charged to place money on deposit with banks. You get charged to lend governments money in the form of buying government bonds. But you can see the monetary expansion has been dramatic, $6 trillion year to date, coming from many central banks, but of course, particularly the Fed. Now, what are the consequences of that is the next slide, Rachel, which is that it's created asset price booms. So here we are, the blue line, just let's focus on that a minute, the S&P 500. So what happened in 2020? Well, it was tickety-boo, we were hitting new highs, COVID came along, the world collapsed and the stock market plunged 34%. Now, to put that in context, compared to previous crises like 2008 or the bursting of the dot-com bubble, usually stock markets fall about 50% in these crises. So why not this time? Because the authorities, the central banks, they couldn't afford a health crisis manifesting into an economic crisis, which was man-made to contain that pandemic. The last thing they could afford was a financial crisis on top of that, which is why these central banks were printing money, buying up assets, and you can see the result of that. We saw not only the sharpest fall in history from a market's perspective, but also the fastest recovery in history, to the point that only last week we were back at new record highs. Now, the next slide, Rachel, on that front is there's still, within that winners of the equity markets, there's still the star performers. And the blue line is the global equity market, the world ex the United States. And actually, it's not been a bad performer, and the recovery has been great. The problem is the scale that I put it on. And the reason I put it on this scale is this red line, which is the FANGs, the technology names, the US technology names, the Facebooks, the Googles, the Netflix, Amazons of the world. Look at the performance of this. It's been spectacular. I'm sure you're all aware of that. But this is a world in which the technology giants have become even gianter, making up a word here, even bigger, even more dominant. They're monopolies. Technology is driving the world. These are the companies with the earnings. These are the companies that are transforming the way business is done. And this, of course, ties into that theme I mentioned earlier, where technology is becoming a major driving force of the global job market as well. The next slide, Rachel, just shows you another element to this, is that technology has become also a battleground for the two global economic superpowers, the US and China. I mentioned the two technology hubs that are being developed. You've all heard about what's happening with Huawei and what's happening with 5G. We're now in a competing world where intellectual capital is being protected, where the two sides are trying to limit each other's ability to move to that next level. But the chart I put in here is an interesting one, because everybody speaks about when is China going to become the largest economy in the world. They've got 1.3 billion people. And my point is, it's going to be a long time when you look at it per capita. The red line here shows you the Chinese GDP on an individual basis. And you can see it's miles behind the United States. In fact, if you look at where China is today, it's only where Korea was back in the 1990s or Japan was back in the 1980s. So it's got a long way to go to really play catch up on an individual basis. But this is also the reason why a lot of countries and economies, not just the United States, but Europe as well and elsewhere, they're trying to contain China right now because of what's known as a middle income trap. It's very hard to get to beyond a certain level and develop a functional middle class society. So there is this period, this window of opportunity where many economies are trying to contain the development of China. And of course, that is having a spillover effect in terms of tariffs and trade, in terms of the technology front as well. And lastly, to sum all of this up, and I appreciate I've been waffling on at a rapid rate, what do we really think? So the good news is, global economy we think is going to continue. It will be dependent on support, but it will continue. Debt levels, deficits will be lasting consequences. And frankly, you know, it's not Ron and I really who have to worry about this at our age. You know, it's the younger generation. These are things that will need to be tackled in the years ahead. So in terms of policy, in terms of growth and generating sustainable, productive growth, this is fundamental, not just for the US, but the rest of the world as well. We don't think there's going to be any change in terms of these drivers. Technology, climate change are going to be very important factors behind all of this. And again, on an optimistic note, I think this ability to deploy capital, the ability to tackle some of these societal issues are going to be positive. They're likely to be net job and wealth creators, provided they're executed correctly and well. And on that front, this is one of the reasons why, again, I'm still a bull on the US. It's still an area where you've got very strong educational system, legal system, deep capital markets, rule of law that still is very much a differentiator. And it's why the US economy is always so dynamic. But one can't be complacent because there are many challenges still ahead. On that note, I've waffled on too much. I'll stop there. Happy to take questions at the end. Over to you, Jessica, and maybe bringing it down to the real world challenges rather than my pontificating in some of the more theoretical ones.
Certainly a tough act to follow there, Guy. Thank you so much. Really enjoyed. And as we transition over, I think Rachel will start out with a quick poll question for the group. Try to get a little bit of a pulse check on What's on everyone's mind today relative to careers? I think the 10 to 15 second rule is a good one.
Give you 5 more seconds. All right.
Okay, so a big focus, first of all, on summer internships, and shortly behind that is full-time jobs after college. So that's great. I'm glad to hear that. And with that, I'm going to make an assumption, go out on a limb here, that most of you are still within your university curriculum, and that you're likely experiencing college in a different way this year, more online interactions, perhaps some greater restrictions and vigilance on campus, and also perhaps off campus as well. All along those lines, you're also going to be experiencing your search for an internship or a career in a very different way this year as well. So the good news is you aren't alone. We're all navigating through those uncharted waters together. I'd love to share with you what some of the career entry points look like at Zurich, just to kind of get us started. And I've got a little bit of a high level of each of those displayed for you here on the slide. First of all, on the left, we have apprentice programs. Zurich North America launched its apprentice program in January of 2016 as the first of its kind in the industry to be certified by the U.S. Department of Labor, something we're very proud of. It's a very successful model that addresses both workforce sustainability as well as provides a debt-free path to professional careers. Zurich has shared its experience and framework with other organizations through the Chicago Apprentice Network, and more recently by catalyzing an industry-wide collaboration through the Insurance Apprenticeship USA, which was announced this spring by the American Property Casualty Insurance Association, and is a good proof point of how our industry is really embracing this model. Zurich Apprentices, if you're curious, work full-time as Zurich employees while attending a local Zurich partner community college where they pursue an associate's degree that's funded by Zurich. So our apprentices earn a full-time salary and benefits, including health insurance and paid time off, in addition to receiving tuition coverage. And currently we offer that apprentice program at our headquarters in North America, which is located in Schaumburg, Illinois, just outside of Chicago, as well as in New York City, but we're also looking to expand our geographic footprint for that program in the US in the next year or so to come. We typically attract to that program based on kind of what I've described, individuals who are just coming out of high school, as well as perhaps transitioning from the military, and sometimes also those who might be changing careers are drawn to this program. So I saw a lot of interest on internships, so I have to talk about that a little bit. Zurich's internship program looks for rising juniors and seniors, as well as MBA candidates who can demonstrate problem-solving skills in a customer-focused environment, a willingness to work hard and to learn, strong written and verbal communication skills, excellent time management skills, flexibility is really important, the ability to work independently, to be self-motivated, as well as strong academic performance. And the objective of our internship program is really to prepare students who are currently enrolled in a degree program, a 4-year degree, for careers in their field of study. In parallel with that experience, though, we of course are also evaluating our interns to determine their potential to move into a full-time role with Zurich after their graduation. Zurich has the complete commitment of our senior management in recruitment and retention of talented college students. Our internship program is formalized and structured, so it encompasses real work assignments, and interns experience formalized program assessments, as well as they also have intern performance assessments throughout the program. They assume the duties of the area as if it were a full-time position. They get to work alongside the professionals who hold those roles today. And in the end, they come away with a unique and well-rounded understanding of Zurich, its products, its services, and its customers, as well as a valuable set of skills and a chance to walk in the shoes of some other professionals, which we think is really important. Another thing that we do as part of those programs that's really compelling to a lot of our participants is that we plan a lot of different networking and team building events during their internship experience. They aren't mandatory, but they're certainly encouraged, and they've been very popular with our past interns. And then finally, over on the right-hand side, our training programs. Zurich's foundational talent training programs really develop new graduates as well as early careerists at an accelerated pace for pivotal technical roles. So actuarial, claims, finance, risk engineering, and underwriting are areas that we offer these programs. And our trainees are introduced to what we call the Zurich Way framework within each of their specific areas through a blended learning approach that consists of classroom training that's delivered by experts and leaders, self-study, mentoring, and on-the-job learning. So they take part also in what we call Crossover Week. A Crossover Week is a comprehensive, challenging, and engaging one-week experience. It starts really early on in the program, and it focuses on Zurich's strategy and culture, an overview of our business units, as well as their interrelationships, which we believe is very important, creating a personal brand, as well as it also offers networking with peers, senior leaders, and even other industry experts. When our trainees have completed the training programs, those participants transition to full-time opportunities within Zurich, where they can leverage everything that they've learned during that experience in their career with Zurich. And it's just the first step on their path forward. We'll move on to the next slide. I'd like to take a moment and kind of wrapping up. So that's what Zurich offers, but I'd like to connect back into a bit of what Guy shared with you during his presentation relative to the global economic outlook. And it really does have a direct impact on what employment opportunities look like short-term as well as in the long term. So one of the top things right now that we're hearing on the minds of many students that we're already speaking with is the tightening job market. We've had some good news over the past week or so on the employment front, so that's a positive. But I think each of you have heard, we had 22 million Americans file for unemployment this year. And students are being directly impacted by lost jobs on campus or around town, or even via internships and full-time opportunities as part of the health crisis that we experienced in 2020. So it's hard to ignore, and it definitely seems to be on everyone's mind. And a tight job market generally means two things. It means for you would be a longer job search and tougher competition for those jobs. So this is a quote. I don't know if you might have seen it before. It's one that I love, but unfortunately have never been able to pin it down to exactly to whom it should be attributed. But regardless, I find it really empowering, and I wanted to share it. When you can't control what's happening, challenge yourself to control the way you respond to what's happening, because that's where your real power is. And our power isn't in those things that we can't control. It is in how we respond to them. So then the question for each of you as you're thinking about internships and full-time opportunities is, so what can you do to position yourself for success? Go to the next slide. Even in a tight job market, there's a lot that you can do to strengthen your position as you begin to seek out professional opportunities, whether through internships or full-time professional roles after college. I'd like to share a little bit with you that was introduced to me many years ago, and it's about managing your PIE, P-I-E. This was shared with me some time back by a senior executive who had been introduced to it by a former mentor, and it's something that's always really resonated with me. It's something I've shared with others, including my own teams. It's simple, and I candidly love things that are easy to remember. So what is PIE? PIE is your performance, your image, and your exposure. So we'll talk a little bit about performance. Make your experience speak, and get creative with how you demonstrate the skills and capabilities that you've acquired. Employers are looking for talents now more than ever that demonstrate adaptability, flexibility, the ability to navigate ambiguity and change, problem-solving capabilities, as well as resilience. So think about it. How can you show you have those skills? Take advantage of learning and volunteer opportunities. It's possible to gain experience that will be attractive to future employers in a myriad of ways. So holding leadership or committee lead roles in registered student organizations. This could be fraternities, sororities, clubs, other student associations and groups. It shows motivation, shows leadership, and it also shows time management skills. Be mindful of your accomplishments and be prepared to share and showcase those during an interview and on your resume. Equally important though, think about some of the roadblocks that you might have incurred in those different roles. How did you navigate them to reach a successful outcome, and be prepared to talk about that. Get creative. Like I said, be creative. Internships are a great way to gain experience. It doesn't need to directly mimic what you want to do after you graduate, as long as it's offering you with some transferable experience you can highlight. This year, many students either missed out on planned internship experiences due to COVID-19, or perhaps they experienced them in a very different way, as many that proceeded were very virtual in nature. So even if, for instance, your internship was canceled, put it on your resume. It's broadly understood that this was a challenging year for internship programs, and that being selected is still a very compelling accomplishment. So be sure to include your selection as part of your resume. You could also gain experience through part-time jobs while in school, whether it's at a local restaurant or retail outlet or within the university. So roles as teaching assistants, resident assistants, or within college community centers or similar, those can be great on your resume. Commonly, those are tougher roles to get, and they often require students to be well networked. So that's something great to showcase. And then staying focused on academics. Many employers will be interested in understanding your academic performance overall, as well as in your core area of study. You might not be able to control what's happening in the economy or the job market, but you can control your focus on your academic performance, which can also be a differentiator for you. Image is the next piece. Be prepared, right? So we've all heard that old adage, if you fail to prepare, then prepare to fail. With most colleges and universities focusing on virtual recruitment efforts this fall, that adage tends to take on an enhanced meaning, as preparation may look a bit differently as well than it once did. So there's the basics, right? Have a soft copy resume ready to share if you're engaged in a virtual booth as part of an online career event. But there's also practice. So a lot more organizations have adopted the practice of video interviews. And it's a good idea to practice for a video interview. Make eye contact with your webcam. Even though there's not somebody there, it's really important to kind of practice staring at that light. Ensuring you have good lighting is important. And dressing appropriately. Dress like you're dressing for an interview that would be in person or a face-to-face meeting. Another thing that a lot of video interview technologies offer that you should take advantage of is the test feature. They tend to be, one's a little different from the other, so that allows you to test the link ahead of time. And by doing that, it will help you to feel more confident that on the day of your interview, you're ready to go. And you don't have to worry about how does this work, where do I look, how do I move this around. Some things don't change. I think the other thing I would highlight is you should still send a thank you email after an event, whether it's a class talk, an interview, or a career fair. Something simple, right? Thank you for your time. It was good to meet you, and I look forward to hearing back. It's a great opportunity also to make yourself memorable. You can customize the message to something you discussed or heard during that interview, and that can be really compelling and help people to differentiate you from someone else. Staying engaged is a great way overall to promote your interest in the industry. So gain ongoing learnings and insights that can be helpful to you, first as you embark on your career, but also in the conversations that you have leading up to that journey. So companies can sense, whether you realize it or not, when you're passionate about the work versus when you're just looking for a job. Your engagement on LinkedIn, for instance, sharing content perspective, or in other industry groups like Spencer, that can really make you stand out. And then finally, exposure. You can't underestimate the ongoing pursuit of new network contacts and gaining new skills and capabilities. Companies are really interested in lifelong learners, those who are curious and motivated to grow and develop themselves. The world obviously is continuing to change, and professionals who embrace that change are a true asset to companies as they also are continuing to transform themselves for the future. So keep building your network, whether it's through online forums or events. We've mentioned LinkedIn, perhaps opportunities through various associations or through your university. One tip I like to give is that when you meet someone, it's great to go ahead and connect with them on LinkedIn and start building that network out. And when you do that, always remember to use the add a note feature to customize your invitation so that they remember, oh, this is how I met you. Oh, this is why you're reaching out to me. This is why I'm someone you want to stay connected with. That'll serve you very well, just that simple extra step. Certifications boost your knowledge and your marketability, right? So look at what certifications you may be able to pursue within the area you're interested in professionally. Getting involved. The give and get tied to involvement with charitable organizations is huge. So first of all, you're obviously contributing to helping others, but you're gaining new skills and experiences along the way. And oftentimes you're also expanding your network in the process. A big one is being open to opportunity. So I kind of saved this for last. Sometimes it's just about getting a foothold. So try to keep an open mind, try to take advantage of opportunities when they come. With each step you take, you're going to learn, you're going to grow, you're going to develop. And honestly, that curiosity and open mindset will often position you for opportunities that you might have missed out on otherwise. So this is how you manage your pie. Your performance, your image, and your exposure. And these are obviously just some ideas on how you might do that. I would invite each of you to kind of take this on and make it your own, and I know you'll find ways to do that. But if you're actively managing your pie, you're also, in doing so, taking back that power to own your future. And just by doing that, you're putting yourself in a more competitive position. So I know we have left some time for some Q&A, and hopefully we've had some things come through. So I'm going to pass it back over to Rachel and Ron.
Well, we have had questions come in. That's great. So again, thanks very much, Guy and Jess. And just for all of you in the audience, we're going to go another 15 minutes. So for those of you that still have time, we have a number of questions. So I know that our speakers have the time to do it. So we'll go and give them a chance to answer some of the questions. So let's dive in, and let me start with the first one. And so Jess, the question is, I understand that compensation alone shouldn't be a determining factor when it comes to choosing a career path. I'm sure you hear that often. Nevertheless, it's important to many. So for students with a finance background who also have the option to go to banking, how do careers in insurance compare competitively in terms of compensation of banking, and how will it be in the post-COVID era?
Wow. So, I think if you are this is the guidance I give. If the Benjamins are very important to you, right? There are a lot of resources online. PayScale is one of them, where you can get a really good sense of what compensation looks like. One of the things I always challenge people to do is look 2 steps ahead as well. Right? So think about what the incoming compensation is. There are definitely some careers where right off the bat, you're going to get paid a lot more, right? But they may not offer as strong of a career pathway. You might have to really put in your time for a longer or extended period. I have to be honest. So my personal experience is I started in IT, and I started in IT because they paid much better. So I will throw that out there. But I learned after maybe a year or so that it just did not connect with my own personal passion for what I wanted to do. So you have to also know yourself. And one of the things I would encourage you to balance is, what does that opportunity actually look like? And it's, again, there's a give and a get there. Is it worth it, or does it look good on paper? And I would always go with the thing that is worth it, because I have found that people who are passionate about what they do, they just naturally excel. And so I would kind of challenge everyone to think about it both ways, not only what comes through on the paycheck, which is important, especially when you're carrying student debt. So I don't discount that, but also what's in it for you in the long term, and where are your aspirations?
Great advice. Thank you, Jess. Another question, this time for Guy. And this is from Michael Ramsey. Michael's a Zurich Spencer recipient, scholarship recipient. So we're delighted to have one. Guy mentioned that he is bullish on the position of the US economy's future. Could he provide more details as to why, as history doesn't seem too kind to world powers when another country challenges its dominance?
No, very, very good question. Yeah, I think it's hard to think of any transition of power that hasn't been without bloodshed and very disruptive. I mean, I guess my point in the US is that when you look at China, because that's who the US is largely being compared with, vying for power, China's had, I've got a lot of respect for the way that the Chinese economy has been handled, the lessons that have been learned, the command system has allowed capital to be moved and directed. But frankly, the easy stuff has been done. There's been a dramatic transformation, move away from poverty in China over the last 20, 50 years. But now we're getting into the difficult part, because demographics, as most of you know, that one-child policy means that we're now at a cliff edge with China. So demographics are going to become a real headwind over the next 20 years for China. Secondly, when you look at the wealth of the population, it's come up a long way very quickly. They compare themselves to their parents and their grandparents' generations, and there's no doubt on a relative basis they look great. But when you compare it, and I showed in that GDP chart per capita, when you compare the middle class of China to the middle class of America, or the middle class of Japan or South Korea, there's a huge gap. And the Chinese problem will be, how do they get to the level that their people will want to be at? How compliant will their people be to the Communist Party if they're finding that there's not enough jobs, or they're not getting to where they want to be quick enough? In comparison, the United States, it's got a positive demographic. If you think about what is GDP, it's a function of productivity and demographics. And the US is one of the few developed world economies that has a positive demographic from an internal basis, but also from an immigration perspective. So right away, there's a tailwind. Secondly, when you look at all these things I mentioned in terms of education, depth of capital markets, the Darwinian concept of survivors, look at these great tech companies. Where are they coming from? They're coming from the United States. I think that China will come into increasing problems in terms of how they're able to challenge and how they compete. Now, I think they will. I think they'll learn. I'm hopeful that competition is a positive one that leads to, an economic race, a technology race. But the question is a very valid one. History is not good in that front. And I can't see the US wanting to cede their #1 spot. And that's why I think there is time on their hands. But let's be honest, the US has got the ball in their court. It's about capitalizing on all of these benefits. It's making sure that you produce technology that's better than China. It's making sure you go up the food chain in terms of producing goods that people really want to buy. And I still believe in liberal democracies. I still believe in the Darwinian application of capital. And right now it's the US is to lose. I think China's a long way behind, but certainly don't underestimate China and benefit from that competitive threat that they are now posing to continue to drive forward.
That's great. Thank you, Guy. There's a number that you kind of addressed a number of aspects of it, which I think is great. So Jessica, there's a number of questions to do with recruitment. And can you talk about when somebody is applying for a job, is it okay to reach out to the recruiter or the hiring leader to find out where your status is in the hiring process?
Yes, I get that question a lot. And yes, it absolutely is okay to reach out and follow up and just say, hey, I'm just checking in, was curious to see where I am in the consideration process. I generally share that over the first couple of weeks, that's when organizations are kind of reviewing and making some decisions. So I would give it a week or two before reaching out, but a reach out is fine. A weekly reach out is probably overkill. I've had people ask me that as well. Should I check in every week? I generally say, no, you probably shouldn't check in every week, but it's absolutely acceptable. And I think that's part of, you know, showing that you're truly interested in the role as well.
You know, another thing, Jess, while we have you, is somebody did ask, they were intrigued with the Apprentice program, and we're asking, is it only for permanent residents? Because the person asking is an international student.
Currently, we're not offering sponsorship opportunities for Apprentice. Like I said, we do offer Apprentice, though, in other countries under Zurich, right? But not for North America.
Yeah. So the person can reach out to us and we can let them know if there's other
Absolutely, absolutely.
Yeah. So there's quite a few interesting questions as well, Guy, to do with you know, the challenge between do we think that people will continue working from home once the virus is behind us? And connected to that is, what does this mean in terms of the economic impact to real estate, to commercial space, to business in general? What's the impact? What could we see for the future?
Yeah, another good question. So yes, I think it is changing the way that we work. Had this been a situation that lasted for 1 or 2 months, I would be skeptical of that, because I don't believe that muscle memory is lost that quickly. But the fact that it's lasted as long as it has, the fact that people have been fortunate enough to have technology have evolved to the point where you can work successfully at home. This conference is a good example of that. I think people are realizing wasted time in terms of commuting, and the fact that they can be productive working remotely. I don't think it applies to everybody, but I think there has been a game changer in terms of what's going to happen. I don't believe, however, you read a lot about the fact that people are exiting cities and the fact that we're going to be fundamentally behaving differently. I don't really believe in that. I think the benefits of cities still there. I think people will get fed up cutting the grass in the suburbs after a while, particularly young people, and they want to go back in where it's still going to be happening. So I don't believe that. To the point about, does it impact real estate? Yes, it does impact. I mean, we've already seen it in terms of the way, frankly, a trend that was already in place in terms of shopping malls, the way people consume, moving to online retailers. I think office space will be changing in terms of the demands, in terms of the flexibility of dynamic office space, and the ability to work from home will alter that as well. But I don't think it's going to be quite as profound as people think. Again, remember I said about extrapolating trends either in the way up or the way down. I think it's usually somewhat more balanced, but I do think there has been a fundamental step change in the way people work. I hated working from home. I had to see my family. I had to speak to my kids and my wife. I was desperate to get back into the office. But even I am beginning to acknowledge that actually working from home has some benefits, if not for my waistline.
And what do you think, Jess? So does this come up very often when you're talking to people, especially new people joining? If they're joining a new company and they're working from home, how does this affect their life and their ability to integrate?
It's certainly different when you're joining a new company, not only working remotely, but keeping in mind we've been hiring this year without meeting face-to-face, which is a big change for a lot of companies as well, because you're not only starting remotely, but you've been hired remotely. So the big challenge is really, how do you convey the company culture and what it really feels like to work at that company when people aren't, in many cases, coming into the office. I think similar to what Guy just described, though, we have found that we have individuals who absolutely love and see it as a benefit to work remotely, and others that are very much yearning for their people time in person. So I think it is very personal as to how people feel about it.
Sure, makes sense. There's a question when we talk about the climate, the environment, et cetera. Guy, there's a question about, it says they see that you're an advocate for responsible investing, green bond market. What's Zurich doing with regard to supporting the green movement?
Yeah, I think it's a topic close to my heart, and frankly, I think Zurich's heart. I think we've got really a three-pronged approach to this. It really kicked off back in 2012, I guess. So One is impact investing, and that ties to green bonds. So back in 2012, 2013, we originally committed $1, then $2 billion to green bonds investment. This is when the market was probably only about 13 or 14 billion, so we were significant players in that. The important thing was to kickstart that, and also realize that you weren't having to give up investment returns to do that. The underlying credit risk was the same as the actual normal credit risk on a normal bond. So one of the things that we wanted to make sure was that we supported these green bonds, but equally we wanted to educate, and this is the second prong of our approach generally, is to try and use our influence and our balance sheet to try and persuade, cajole others to join. Also use that persuasion to discourage bad behavior in terms of some of the investment in the companies that we've got. So that's been a very important point to that. And then the third part to it is really the integration of ESG factors, not as an afterthought, but embedded in all the processes that we've got. And going back to that first point about the impact side, I'm pleased to say that we've gone from 1 to 2, now 5 billion commitment in terms of impact investing. But again, it's about being an advocate. And when I'm out, and the rest of my colleagues are out there as well, the number of questions that we get on this subject, it gives us a platform in which to show that Zurich is not only talking a good game, but is actually living it in terms of the investment portfolios and the broader insurance business that we're now writing.
Very good. So I've just got a couple of final. One of them, again, to do with the enormous technological changes and the continuous increase in population. Two questions that are related. One is it going to lead to high levels of unemployment because of machine learning and robotics and API taking over, what humans were doing before? And secondly, what about from a resource viewpoint, when you look at meat, meat being replaced and done in labs and this type of thing?
Is that to me or Jess? Do you want to?
So why don't you start off, Guy, from an economic viewpoint?
I think every time we've had a technological revolution, the threat has always been about losing jobs. You think about the Luddites back in the UK when the spinning jennies were brought in and people were rebelling against technological change. Certainly from the 1850s, every time we've seen a technological shift, it's actually generated more jobs because of all the spin-off that comes from these new technologies and new applications and new processes. And I think this really is no different. I mean, people are saying, of course, it's one thing displacing manual workers because they can reasonably quickly retrain for other production line work back in the Industrial Revolution. It gets progressively harder for skilled workers to do that. And I agree with that. That's why I think continuous learning, on-the-job learning is going to be so important. But I have very little doubt that while it's still seen as a disruptor and as a potential threat, I suspect over time it's going to be a generator of new opportunities and new jobs rather than a detractor from that problem.
Does this come up a lot, Jess, in terms of the whole issue? Will there be jobs and how much will be replaced through machine learning, et cetera?
I think similar to what Guy mentioned, as you think about the future of work, I think it will look differently than it does today. And while some tasks, I think we tend to look at some tasks may be replaced through automation, jobs will change. I think that kind of goes back to that whole idea of talents needing to be adaptable and flexible, and that being of such interest to companies because companies see that coming and they want workforces that are open to adapting and quickly in a very agile manner moving into what those future ways of working will look like and what that would mean for specific roles even.
So Jess, just in closing, before I pass it back to Rachel, there's a number of questions here about internships and how do I apply and will Zurich go to job fairs? And just like a lot of other insurers will show up at job fairs. And so I think, can you just comment about, they ask, is the recruiting website updated? Do you put new positions on it? Can you just say, if you're a student or you're somebody listening to the webinar and they're saying, hey, I'm interested in what possibilities there are, how would it work at Zurich? And in general, I'm sure other companies must do similar things. So can you give some advice about what do we do and what advice do you have for the students?
Absolutely. Zurich is attending multiple virtual career events this fall. and we are continuing to grow the list of events as those are being defined by the different universities and colleges. So first of all, I would say kind of keeping an eye out for what's happening virtually on campus at your college or university. Secondly, we do post all of those openings on our career site at www.zurichna.com/careers. So you can see those in real time and or subscribe to notifications if you'd like to be alerted as new openings come to pass. So we will be very active this fall, and obviously I'm on LinkedIn, so feel free to connect with me as well if I can be of help.
Great advice, and it follows what you were saying as well, to be active and engaged, etc. So look, thanks so much, Jess and Guy, for your comments. Thanks to the audience for so many questions, and Rachel, let's pass it back to you.
Awesome. Thank you so much, Ron. And just echoing what you said, Jess and Guy and Ron as well, thank you so much for this incredible presentation. I personally just had a blast. And I want to thank everyone again on the line for joining and for all of your questions. And I know we didn't get to answer all of them exactly in detail. So please, if you have any other further questions, feel free. You should all have my email from the invite. I welcome you to reach out, and I can connect you to channels across the network. I'm more than happy to answer questions and help you out if you need. And so once again, from all of us at Spencer, on behalf of the foundation, I want to thank Zurich for their support and thank each of you individually for your time today. It was excellent. And again, this session has been recorded, and so I will be sending that out to folks who registered if you want to check back on something that you missed or you want to share with somebody who wasn't able to be here today. So thank you again.
Thank you all. Bye.
Thanks, everybody.